Hello, I'm John A.G. Silver just exposed a pricing fracture that should not exist in a functioning commodity market. Two of the largest primary silver producers in the world closed out the fourth quarter of 2025 with record output, record revenue, and record operating cash flow. On the surface, that aligns with a rising price environment. But buried inside their earnings reports was a number that contradicts the benchmark most investors rely on. First Majestic reported an average realized silver price of $69.74 per ounce. During that same quarter, the average COMEX silver price was roughly $55. That is not a rounding difference. It is a premium of about $14 per ounce, roughly 26% above the exchange reference. Hecla Mining reported an almost identical realized price near $69.29 per ounce, again approximately 26% above the COMEX average. Two separate producers operating independently, both clearing physical metal at materially higher prices than the so-called official market. That divergence is not normal. In a properly aligned commodity system, realized prices track the benchmark within small transport or quality differentials. A sustained 26% premium signals something else entirely. It suggests that the exchange screen price is not the clearing price for physical silver in size. It implies that actual end buyers are willing to bypass Western exchanges and pay materially more for assured delivery. When producers consistently receive prices far above the futures reference, the benchmark is no longer dictating the real economy. It is reacting to a different layer of activity. The immediate assumption many investors make is that this must be an anomaly, perhaps a timing benefit, perhaps hedging effects, perhaps contract mix distortions. But when two major primary producers report nearly the same premium magnitude in the same quarter, coincidence becomes statistically weak. These companies are not liquidating inventory on COMEX at settlement. They are entering direct sales agreements and bilateral contracts with counterparties willing to secure supply outside the paper system. That alone should change how price discovery is interpreted. The false comfort trap is the belief that COMEX and LBMA represent the full market. Investors look at the screen, see $55, and assume that is what silver is worth globally, yet physical users appear willing to transact closer to $69. If industrial buyers could easily obtain large volumes at 55s with guaranteed delivery, there would be no rational reason to pay a 26% premium elsewhere. Either delivery friction exists, or confidence in the paper claim structure has eroded, or both. In either case, the spread reflects stress. The early mechanism here is straightforward. Western exchanges operate heavily on derivative contracts. A futures contract represents a promise to deliver metal at a later date. In practice, most contracts are cash settled or rolled. Physical delivery volumes are small relative to total open interest. The system functions because only a minority of participants demand actual bars. If that balance shifts, price behavior changes quickly. By contrast, in Shanghai, the exchange requires physical backing for trades. Contracts are more tightly linked to warehouse inventory. That structural difference matters when supply tightens. Over recent months, silver traded in Shanghai at a persistent premium to London and New York. Not for days, but for extended periods. That premium was often attributed to regional demand conditions. But when primary producers report realized prices matching those elevated levels, the premium is no longer regional noise. It becomes part of the global clearing dynamic. The screen in New York can say one thing, while the real metal clears elsewhere at another. Consequences escalate from there. If physical buyers increasingly transact directly with producers at premiums, fewer ounces flow through exchange warehouses. Registered inventories become thinner relative to open interest. Futures prices, meanwhile, remain influenced by leverage positioning, margin changes, and speculative flows. In late January, COMEX implemented multiple margin increases within days. The silver price on the exchange fell sharply, nearly 30% in short order. Yet nothing changed in global mine output overnight. Nothing changed in fabrication demand overnight. What changed was the cost of holding leveraged paper positions. Traders were forced to liquidate. The screen price collapsed. That event demonstrated how sensitive the paper market is to financial conditions rather than physical supply. If physical premiums persisted during that margin-induced decline, then the divergence widened precisely when the benchmark suggested weakness. That would indicate two markets moving on different drivers, one reacting to leverage constraints, the other reacting to availability and security of supply. When a commodity's financial layer disconnects from its industrial layer, the longer-term equilibrium becomes unstable. There is also a dollar dimension embedded in this shift. The global reserve system still relies heavily on dollar-denominated assets and settlement channels, but after the freezing of Russia's reserves in 2022, central banks absorbed a lesson about counterparty risk. China has increased official gold reserves for multiple consecutive months, reaching 2,199 metric tons by mid-2025. Analysts suspect actual holdings may be materially higher, potentially above 5,000 tons, when accounting for opaque trade flows. The strategic logic is simple. Physical bullion held domestically cannot be sanctioned digitally. It carries no issuer risk. If gold is being accumulated quietly to reduce exposure to dollar weaponization, silver's strategic relevance should not be ignored. Silver carries monetary history and deep industrial importance in electronics, solar infrastructure, and advanced manufacturing. Persistent Shanghai premiums and eastward metal flows are consistent with accumulation behavior. When physical metal moves into long-term strategic reserves, it does not reappear easily in tradable float. That reduces elasticity of supply in future stress periods. Institutional capital notices these shifts. Large industrial consumers prefer certainty over theoretical price efficiency. If delivery timelines stretch or exchange inventories look thin relative to claims, corporations sign offtake agreements directly with miners. They accept premiums in exchange for guaranteed supply. That behavior further marginalizes the exchange benchmark. As bilateral contracts increase, the visible pool of metal supporting futures contracts shrinks proportionally. Technical analysis still matters in the short term. Silver experienced strong upside momentum during the Chinese New Year period, rising nearly 17% while Western trading participation was thin. Some of that move reflected tariff tensions, geopolitical friction involving U.S.-Iran relations, and broader safe haven demand across metals and energy. But thin liquidity also means price can overshoot. Momentum indicators can become extended quickly. A divergence thesis does not eliminate volatility. It simply reframes what volatility represents. Policy constraints add another layer. The Federal Reserve operates within a narrow corridor. Inflation pressures remain uneven while growth signals fluctuate. If inflation expectations rise due to energy or supply chain disruptions, tightening policy further risks slowing economic activity. Yet easing policy aggressively risks currency weakness. In such an environment, commodities sensitive to both monetary conditions and geopolitical tension can experience nonlinear price responses. System fragility emerges when multiple pressures converge. If exchange inventories decline while open interest remains elevated, delivery risk perception increases. If central banks continue diversifying reserves away from dollar assets, long-term confidence in paper claims weakens. If fiscal deficits remain large and Treasury issuance expands, real rates become more politically sensitive. Each variable alone is manageable. Together they compress flexibility. The unresolved question is not whether silver is volatile, it is whether the benchmark price still represents the clearing reality for physical metal. Two major producers receiving roughly 26% premiums suggest that at least part of the market is operating on a different axis. Either physical buyers are overpaying irrationally, or the futures price is underrepresenting scarcity and risk. Both conditions cannot persist indefinitely. The next round of quarterly producer reports will provide additional data. If realized prices continue to exceed exchange averages materially, the structural divergence argument strengthens. If they converge, the fourth quarter may prove exceptional. For now, the existence of sustained premiums, margin-driven price collapses disconnected from physical supply, and persistent eastward metal flows indicates a tightening system operating beneath the surface of the screen price. The visible quote is calm. The underlying mechanics are not. The divergence between paper and physical silver did not emerge in isolation. It developed within a broader shift in how price discovery is distributed globally. For decades, London and New York functioned as unquestioned benchmarks. The LBMA fix and the COMEX settlement price were treated as authoritative references for contracts worldwide. Producers, refiners, fabricators, and investors all indexed transactions to those levels. That benchmark authority created a reinforcing loop. Liquidity concentrated in the West, and because liquidity concentrated there, price influenced it as well. But benchmark power depends on trust that the quoted price reflects accessible supply. Once realized transactions consistently clear elsewhere at materially higher levels, the authority of that benchmark begins to erode. Shanghai has quietly become a pressure valve for that erosion. The structure of its exchange requires stronger linkage between contracts and warehouse stocks. Physical settlement is not theoretical, it is embedded in the rules. When silver trades at a persistent premium in Shanghai relative to London and New York, that premium represents either excess local demand or structural friction in Western delivery channels. When primary producers then report realized prices matching those elevated Asian levels, the signal becomes harder to dismiss as regional imbalance. It begins to look like an alternative center of gravity forming around physical assurance rather than derivative leverage. The immediate market shock remains the same. Producers realized roughly $69 per ounce while the futures benchmark averaged near $55. But the deeper implication concerns what happens if more producers adopt the same distribution strategy. If miners increasingly allocate output through direct bilateral contracts to industrial end users, or to Asian hubs offering stronger physical premiums, fewer ounces will be offered into Western exchange warehouses. That does not cause an immediate shortage. It changes the ratio between paper claims and registered metal. Futures markets can function with high claim-to-metal ratios as long as delivery demands remain modest. The vulnerability appears only when participants begin testing that ratio. Investors often assume that futures exchanges can always source metal if needed. That assumption rests on the idea that warehouse stocks represent a stable buffer. Yet warehouse stocks fluctuate. Metal can be reclassified between eligible and registered categories. It can move across borders. It can be encumbered by private agreements. The headline inventory number does not necessarily reflect immediately deliverable free float. When realized prices outside the exchange exceed the benchmark by double digits percentage-wise, it suggests that some buyers do not believe warehouse access is frictionless. Escalating consequences begin with fiscal math. Governments facing large deficits depend on stable funding costs. If inflation expectations rise because commodity prices trend higher, bond yields can respond. Higher yields increase debt servicing burdens. Policymakers are then forced into a delicate balancing act between maintaining price stability and sustaining growth. Silver, though smaller than gold in monetary symbolism, participates in this broader inflation narrative. A sustained divergence indicating tighter physical supply can feed into broader commodity inflation expectations, particularly if energy prices move simultaneously due to geopolitical tension. The dollar sits at the center of this equation. Dollar strength often suppresses commodity prices in nominal terms. But confidence in dollar-denominated reserves has already been tested by sanction episodes. If central banks diversify incrementally toward bullion, they reduce marginal demand for treasuries. That does not trigger immediate collapse. It shifts long-term demand curves gradually. Over time, that influences funding conditions and exchange rate stability. In such a setting, commodities tied to real asset hedging can attract structural allocation flows independent of speculative positioning. Energy markets add another layer of sensitivity. Silver's industrial demand is heavily connected to photovoltaic production and electronics. Renewable energy expansion requires significant silver input per megawatt installed. If global energy policy accelerates solar capacity deployment, fabrication demand becomes less discretionary. When industrial demand is policy supported rather than purely cyclical, supply constraints exert more persistent price pressure. Combine that with geopolitical tension that lifts oil and gas prices, and you have a commodity complex that reinforces inflation signals rather than dampens them. Geopolitics complicates capital flows further. US-China trade tensions, tariff adjustments, and strategic decoupling efforts alter supply chains. If tariffs increase uncertainty around cross-border trade, companies preemptively secure raw materials to mitigate disruption risk. That hoarding behavior tightens spot markets. It also increases willingness to pay premiums for guaranteed delivery. The premium becomes an insurance cost embedded in procurement strategy. What appears on the futures screen may not capture that insurance value. The delayed structural risk lies in what happens if this divergence persists long enough to alter behavior permanently. Market structures are path-dependent. Once producers develop alternative distribution networks that deliver superior realized prices, they have little incentive to revert to exchange-dependent sales. Once industrial users secure long-term offtake contracts at premium levels, they reduce reliance on spot markets. Over time, visible liquidity in the futures complex may shrink relative to global physical flows. The benchmark becomes more detached, not less. Institutional repositioning often occurs quietly before headlines catch up. Large asset managers monitor basis spreads between regions. They analyze producer-realized price disclosures carefully. If they conclude that the futures benchmark understates tightness in the physical market, they may increase allocations to mining equities or physically backed vehicles rather than derivative-heavy instruments. That shift changes capital distribution within the sector. Producers with strong balance sheets and direct sales channels benefit disproportionately. Exchange-traded funds relying on unallocated metal structures may face greater scrutiny regarding custodial arrangements and counterparty exposure. None of this eliminates the importance of technical counterbalance. Silver remains historically volatile. Rapid advances can invite profit-taking. Overbought conditions on momentum oscillators can lead to sharp corrections even within structurally bullish frameworks. The January margin increases demonstrated how quickly paper markets can unwind when leverage becomes expensive. A divergence thesis does not immunize price from liquidity shocks. It simply reframes those shocks as potentially less representative of physical supply-demand equilibrium. Policy constraints deepen the tension. The Federal Reserve faces a dual mandate of price stability and employment. If commodity prices signal inflation persistence, policy tightening would normally follow, yet higher rates strain debt-laden sectors and increase federal interest expense. Fiscal authorities simultaneously confront rising entitlement spending and defense commitments. The interaction between monetary tightening and fiscal expansion narrows maneuvering room. In that compressed space, market participants become more sensitive to alternative stores of value. System fragility becomes visible when flexibility declines. If exchanges rely on high leverage to maintain liquidity, but margin adjustments cause outsized price swings, credibility can erode. If central banks accumulate bullion quietly while public narratives emphasize paper stability, informational asymmetry widens. If industrial users consistently pay premiums above benchmarks, confidence in those benchmarks weakens incrementally. None of these dynamics produce instant crisis. They accumulate. The question of what breaks first remains open. It could be a visible delivery squeeze where too many longs stand for physical and available registered stocks prove insufficient, forcing cash settlement or emergency rule adjustments. It could be a gradual migration of price discovery toward Asian hubs, reducing Western influence without dramatic confrontation. It could be a convergence event where futures prices rise materially to align with realized physical premiums, temporarily restoring balance. Or it could be regulatory intervention aimed at narrowing spreads through reporting changes or margin policy recalibration. What cannot persist indefinitely is a 26% gap between realized producer prices and exchange averages without behavioral consequences. Markets are adaptive systems. Participants respond to incentives. If selling outside the exchange yields materially higher revenue, producers will continue doing so. If securing direct supply mitigates operational risk for manufacturers, they will continue paying premiums. Each rational decision compounds structural change. Meanwhile, investors anchored to screen quotes may underestimate underlying tightness. The benchmark still prints daily, charts still oscillate, volume still flows. But the informational content of that print may be degrading relative to physical transactions occurring off-screen. The credibility of any price depends on its connection to deliverable supply. When that connection weakens, price becomes a financial abstraction rather than a physical signal. In the coming quarters, realized price disclosures will serve as a diagnostic tool. If premiums narrow significantly, it would suggest that fourth quarter conditions were exceptional, perhaps influenced by timing of shipments or regional demand spikes. If premiums persist or expand, the case for structural divergence strengthens. That evidence will not arrive through headlines. It will arrive in earnings tables, footnotes, and average realized price metrics that many investors overlook. Until then, the market operates in a bifurcated state. Futures volatility reflects leverage and liquidity conditions. Physical premiums reflect scarcity and security of supply. Central bank behavior reflects geopolitical risk management. Fiscal trajectories reflect debt sustainability challenges. Energy policy reflects strategic industrial planning. Silver intersects all of these layers simultaneously. The unsettling variable is confidence. Futures markets depend on confidence that contracts can convert into metal if required. Industrial buyers depend on confidence that inputs arrive on schedule. Central banks depend on confidence that reserves cannot be frozen. When confidence fragments across these domains, pricing coherence weakens. The divergence between $55 and $69 is not merely arithmetic. It is a symptom of that fragmentation. Whether the system self-corrects through convergence or escalates toward a more visible rupture remains unresolved. What is clear is that price signals are no longer singular. There is the visible quote and the realized transaction. There is the leveraged position and the secured shipment. There is the derivative claim and the vaulted bar. When those pairs separate meaningfully, the structure supporting them is under strain. The tension now moves from observation to implication. If physical silver continues clearing at premiums well above the futures benchmark, the market is not simply mispriced, it is segmented. Segmented markets behave differently from unified ones. In a unified market, arbitrage closes gaps quickly. Traders buy the cheap venue and sell the expensive one until prices converge. A 26% spread would normally invite aggressive arbitrage capital. The reason it persists suggests friction. That friction can take many forms: logistical delays, capital controls, delivery bottlenecks, or structural limits on converting paper claims into immediate physical supply at scale. Arbitrage assumes that futures contracts can be converted into deliverable bars efficiently. In theory, a participant could purchase silver on COMEX at 55, stand for delivery, transport it, and sell into a higher-priced venue near 69. If that path were seamless, the spread would collapse rapidly. Persistent premiums imply that either the path is not seamless, the volume available for delivery is insufficient relative to demand, or the risk of attempting the conversion is high enough to deter capital from fully closing the gap. That alone reframes the benchmark's authority. Escalating consequences extend into how exchanges manage risk. When margin requirements were raised sharply in late January, the paper price declined rapidly, close to 30% in a compressed window. Margin policy does not alter mine supply or fabrication demand. It alters the cost of leverage. If a price drop of that magnitude can be induced through financial rule adjustments without a corresponding change in physical flows, then the benchmark is highly sensitive to credit conditions. In contrast, realized producer prices reflect contracts already negotiated and deliveries already scheduled. Those prices respond to supply-demand fundamentals, not to intraday leverage recalibration. This creates a feedback loop. If market participants perceive that the futures price can be depressed by margin policy, even while physical demand remains strong, they may reduce reliance on that price as a procurement reference. Industrial users may prefer longer-term contracts indexed to alternative pricing mechanisms or negotiated premiums rather than spot futures. Producers may continue favoring direct sales. Each incremental shift reduces the share of global silver transacting through Western exchanges. The fiscal layer compounds this shift. Governments running sustained deficits require predictable financing conditions. If commodity prices trend higher due to structural tightness, inflation expectations may firm. Bond yields can respond upward, raising borrowing costs. Policymakers may attempt to counteract that pressure with tighter monetary policy, but tightening increases interest expense on existing debt. The result is a narrowing corridor between inflation control and fiscal sustainability. Precious metals often gain attention when that corridor tightens because they represent assets outside sovereign credit systems. Dollar dynamics intersect here again. The reserve currency benefits from deep capital markets and trust in legal frameworks. Yet episodes involving asset freezes have introduced geopolitical risk into reserve management decisions. China's official gold reserves have risen for multiple consecutive months, reaching 2,299 metric tons by mid-2025, with external analysts estimating total holdings could exceed 5,000 tons when accounting for unreported inflows. The strategic message is diversification away from sanction-sensitive assets. Silver, while less central bank dominated than gold, shares the attribute of being a tangible asset without counterparty exposure. If physical silver continues flowing eastward into private or state-aligned vaults, those ounces effectively exit tradable circulation. Silver differs from gold in that much of it is consumed industrially and not easily recovered. When inventories tighten, replenishment depends on mine output and recycling, both of which have lead times and cost structures. A persistent premium environment encourages mine expansion, but expansion projects require capital, permitting, and multi-year development timelines. Supply cannot respond instantly to price signals. Institutional repositioning reflects these realities. Mining equities that report realized prices above benchmarks demonstrate operating leverage not visible from futures charts alone. Investors analyzing earnings may begin valuing these firms on realized pricing power rather than on screen quotes. Meanwhile, exchange-traded products holding unallocated metal structures may face deeper scrutiny regarding custodial arrangements and the mechanics of redemption under stress. Allocation decisions shift quietly, but capital flows follow perceived structural advantage. A technical counterbalance remains essential. Markets rarely move in straight lines. Silver's historical volatility means that sharp rallies can retrace meaningfully. If the paper price converges upward toward realized premiums, that convergence may occur through rapid speculative inflows, creating overextended momentum. Corrections would then be natural, even within a structurally tight framework. The divergence thesis does not eliminate cyclical swings, it contextualizes them. Policy constraint intensifies if inflation pressures coincide with slowing growth. The Federal Reserve must weigh labor market resilience against price stability. If energy prices rise due to geopolitical tension while commodity inputs tighten due to structural supply shifts, inflation may prove sticky. Raising rates into slowing growth increases recession risk. Holding rates, steady risks, currency depreciation, and inflation entrenchment. In such a trap, policy becomes reactive rather than proactive. System fragility emerges when multiple domains experience reduced flexibility simultaneously. Exchange inventories that appear adequate during calm periods may prove insufficient under concentrated delivery demand. Fiscal deficits that are manageable under low yields become heavier under rising rates. Supply chains that operate efficiently under predictable trade conditions strain under tariff adjustments or sanctions. Each domain may function individually, but interconnection amplifies stress. Consider a scenario where more longs decide to stand for delivery during a period of visible divergence. If registered stocks are drawn down quickly, exchange administrators could encourage cash settlement or modify rules. Such actions, even if legally permissible, would signal that the benchmark relies heavily on financial settlement rather than physical transfer. Confidence would adjust accordingly. Alternatively, futures prices could rise materially to align with physical premiums, restoring parity without overt stress. That path would validate the idea that the screen was lagging reality. Another possibility is gradual migration of price discovery. If Shanghai or other physically anchored venues continue to command premiums and attract producer supply, over time contracts may increasingly reference those prices. The shift need not be dramatic. It could unfold incrementally as commercial participants alter procurement practices. Benchmark influence erodes not through collapse but through displacement. The larger question concerns which market participants are surprised. Retail investors often focus on visible quotes. Industrial buyers focus on shipment certainty. Central banks focus on sanction resilience. Hedge funds focus on volatility and leverage. When these priorities diverge, pricing layers separate. The 26% premium reported by two major producers indicates that at least one layer of participants values physical certainty significantly more than the leverage benchmark suggests. Confidence erosion does not announce itself loudly. It appears first in spreads, in basis anomalies, in realized price discrepancies. It surfaces in earnings reports rather than headlines. It manifests in inventory transfers from west to east. It reveals itself when margin adjustments move prices more than changes in mine output do. Each data point alone is manageable. Together they sketch a system operating under compression. In the near term, attention turns again to forthcoming quarterly reports. If first quarter 2026 realized prices remain substantially above the COMEX average, the divergence narrative strengthens. If premiums narrow sharply, it may indicate that distribution channels normalized or that fourth quarter shipments were unusually timed. The data will matter more than commentary. At a broader level, silver now sits at the intersection of monetary policy constraints, fiscal arithmetic, geopolitical recalibration, and industrial transformation. Solar deployment targets require sustained silver input. Electronics demand remains structurally significant. Central bank diversification trends emphasize tangible reserves. Exchange mechanisms depend on leverage confidence. Each force exerts pressure in a different direction. The market's apparent calm on the screen masks these cross-currents. The visible quote is still treated as authoritative by many participants. Yet realized transactions tell a more nuanced story. When producers consistently receive prices far above that quote, the benchmark's informational content weakens. Price becomes less about equilibrium and more about financial positioning. The unresolved tension is whether convergence will occur through upward adjustment of the benchmark or through structural sidelining of that benchmark. If futures prices rise materially to match physical clearing levels, investors anchored to $55 will need to reassess valuation assumptions. If instead physical markets continue drifting away while the benchmark remains dominated by leverage cycles, the divergence may become embedded. In either outcome, confidence is central. Markets function efficiently when participants believe claims can be converted into assets reliably. If conversion risk increases, premiums expand. If premiums expand persistently, structural change follows. The difference between $55 and $69 is not simply a number. It is a signal that parts of the silver market are pricing risk differently. The system has not broken. Delivery continues. Exchanges operate. Producers mine. Fabricators manufacture. But the alignment between financial representation and physical reality appears less tight than it once was. Whether that misalignment resolves quietly or forces a more visible recalibration remains uncertain. The next data releases will provide clues, but not final answers. What matters now is recognizing that two prices have emerged for the same metal. One reflects leveraged derivatives trading in established Western venues. The other reflects realized transactions for immediate physical supply. They cannot diverge indefinitely without consequence. The question is not whether volatility will continue. It is which layer of the market ultimately dictates value when confidence is tested.